Hello students, today we are going to solve another type of problem. So let's solve this. So the problem says the stock of Box Limited performs relatively well to other stocks during recessionary periods. The stock of Cox Limited on the other hand does well during growth periods. So they are telling two types of period. One is in recession, Box is performing well, and in growth stage, Cox is performing well. We have two stocks here. Both the stocks are currently selling for rupees 100 per share. So one share is costing is 100 per share. So you assess the rupee return, that is dividend plus price of these stocks for the next year as follows. So they have given the economic condition: high growth, low growth, stagnation, and recession. And the probability in high growth is 0.3, in low growth 0.4, stagnation 0.2, recession 0.1. And we have written on Box Limited and we have written on Cox Limited, that is Cox stocks and Box stock. So with this, he is asking us calculate the expected return and standard deviation of investing. Question A, rupees 1000 in the equity stock of Box Limited. So first question is they are stating that we have to calculate investing 1000 rupees in, that is just on Box Limited. Okay, so let's start question A. Then we will solve B and C. So the question is 1000 we are investing in the Box Limited. So we have to calculate the return, okay, and the other score we can call deviation. So if you see, one share is costing rupees. So we'll first write solution here. So one share is costing us 100 rupees. So we have 1000 rupees to invest. It means, so we can purchase 10 equity. Sorry, I'll just rub it. We can take 10 equity shares. 10 equity shares of Box Limited. We can purchase 10 equity shares of Box Limited with the help of can be about 4 rupees 1000. So we have 1000 rupees with us. So and he has given that what is the return of Box Limited. High growth it is 100, low growth is 110, and stagnation 120 and 150. So let's calculate the earnings, how the earning will be an expected return. So here I will write economic condition, and here I will write overall return, and this will be probability, and the last column I will write it as expected return. Okay, expected return. So the above data is already given to us. So let's take it. We have high growth, we have low growth, then we have stagnation, then we have recession. Okay, so we have 10 stock with us. Okay, in all we can purchase 10 from 1000 rupees. Okay, now in first case high growth, so the return is 100. Okay, so if return is 100, then the stockholder will get earning will be rupees 1000, and in low growth it is 110, so it will be, I will just write rupees 1100, and in stagnation it is 120, so I will get 1200. And for recession, we get 140. So here the earnings will be 1400. So these are the particular situation, and we have 10 stocks with us. So return for each stock will be 100. So we will be earning, overall return will be in high growth 1000, low growth 1100, stagnation 1200, and recession 1400. We have probability with us, that is 0.3 possibility, 0.4, 0.2, and 0.1. Okay, so we have this. Now let's calculate expected return. So expected return formula, you know that, return into probability. So I will just put here column number 1, 2, 3, and 4. So expected return is column number 2 into column number 3. So 0.3 into 1000, and that will be 300. Okay, and 0.4 into 1100, so it will be 440, and 0.2 into 1200, so that will be 240, and 0.1 into 400, that is 140. So the expected return, that is total, if we calculate by adding this all, so it will be rupees 1, it will be 1120. So the expected return for Box Limited, if you are investing 1000 rupees, so we will get 1120. Now let's calculate the standard deviation. So standard deviation is equal to, so we have to calculate variance, then we can root it, so we can get the standard deviation. So let's sum. So 0.3 is the probability, okay, and 1000 is the return, and average is expected return is 1120 square plus 0.4, 1100 minus 1120 square plus 0.2, 1200 minus 1120 square plus 0.1 into 1400, 0.1 into 1400 minus 1120 bracket square. So after calculating this, so we get the values. So here, after solving the first, we get 4320 plus 160 plus 1280 plus 7840 then total adding this we get 13,600. So by rooting 13,600, so we get the value, that is rupees 116.60. So we get the standard deviation of return is 116.62. Okay. Now let's go for question B. So question B says ₹1000 in equity stocks of Cox Limited. So first case we invested in Box. The next case we are investing in Cox Limited. So let's solve it. Again, same thing. Solution for B. So if the cost is 10, so again the same thing, we can purchase 10 equity shares of Cox Limited. Okay, we can purchase 10 equity shares of Cox. So again, same columns comes. So here, economic condition. Second is overall return, and then probability, and the last is expected return. So economic condition we know. First is high growth. Second is stagnation. Sorry, second is low growth. Third is stagnation, and last one is recession. So overall return we can calculate. So we know the 10 shares we are having with us in all cases, and the first case it is 150. So here we will be earning rupees 1500. Okay, in second case it is 130. So we'll be earning rupees 1300. And in 10th case, this case, so it's 90. So we'll be earning rupees 900. And at recession, it is 60. So we'll be earning rupees 600. Rupees 600. Now we know the probability. Again, that will be the same. That is 0.3, 0.4, 0.2, and 0.1. So expected return, that again same thing. We'll just put column number here, 1, 2, 3, 4. So column number 2 into column number 3. So 1500 into 0.3, that will be 450, and this will be 520, and 180, and 60. So total of expected return, it will be rupees 1210. So we have calculated the expected return. Now let's move to calculate the standard deviation. So standard deviation again remain the same. That is SD is equal to, okay, we calculate variance, then we rotate and we will get the value. So if you see here again, so 0.3 is the probability, 1500 minus 1210 square, okay, plus 0.4, 1300 minus 1210 square, plus 0.2, 900 minus 1210 square, plus 0.1 bracket 600 minus 1210 bracket square. Okay, now after simplification, so here we get 25,230 plus 3,240 plus 19,220 plus 37,210. So total will get 84,900. So standard deviation root 84,900, that is rupees 291.4. So here risk is more than compared to investing 1,000 rupees in box limited. So, but the return is huge. With the risk, return is also huge. So let's move to the question number 3. So question number 3, that is C, says rupees 500 each in the equity stocks of Box Limited and Cox Limited. So here 1,000 rupees. So 500 will be in Box Limited and 500 rupees will be invested in Cox Limited. So let's solve this. So solution. Or C. So we can purchase 5 stocks of Cox Limited, 5 equity shares of Box Limited and 5 equity shares of Cox Limited from rupees 1,000. So again we will have the same condition here, that is economic condition, then overall return, then probability, and then we have the expected return. So economic conditions, again same. First is high growth, second is low growth, third is stagnation period, and last is recession. So let's put these values in overall return, that is we have 5 shares of Box, okay, and so multiplying 5 to 100 return, then to 110, then 120 and 140. Okay, now plus we are investing 5, we are investing in both the shares, so 5 equity of Box and 5 equity of Cox. So 5 into 150, 5 into 130, okay, 5 into 90, and 5 into 60. So here we get the value after multiplying and adding. So here we get rupees 1250, and here we get rupees 1200. So here we get rupees 1050, and here we get rupees 1000. Okay, so probability we know, that is 0.3, 0.4, 0.2, and 0.1. So expected return, so here again column number 2 into column number 3. So here we get values like 375, 480, then 210, then 100. So after adding all, so we get rupees 1165 if you are investing 50-50 in both the stock. So 5 equity shares of Box and 5 equity shares of Cox Limited. Now let's calculate the standard deviation. So SD is equal to, so 0.3 into 1250 minus expected return 1165 square plus 0.4, 1200 minus 1165 square plus 0.2, 1050 minus 1165 square plus 0.1 into 1000 minus 1165 square. Okay. Now after simplification, we get the values to 167.5 plus 490 plus 2645 plus 2722.5. So is equal to, so we get, that is 8025. So routing 8025, so we get rupees 89.6. So this is when we are investing purchasing five shares of Cox and 5 shares of Box. If we compare all the thing, so if we are investing in security A, that is Cox Limited, return will be 1120 and risk will be 116. And if you are investing in B whole amount, that we will get 1210 will be the return, and risk will be rupees 291.4, which is high. But if you are investing in both the stocks, we get return 1165. With that, we get even less standard deviation, that is the risk.